Guys, Warren Buffett just issued his most daunting warning to Wall Street. Yet it couldn't be any clearer. Guys, let's go ahead and read this article. And for those who aren't aware, we've had a pretty severe crash this past week in the market overall. I don't want to say it's a huge crash, but we've been dealing with some stuff going on. So let's go ahead and read this article together. Let's analyze. It says each quarter, investors anxiously await the release of Berkshire Hathaway 13F filing. The Securities and Exchange Commission (SEC) requires most large funds to disclose what stocks they owned at the end of each quarter. This effectively allows the public to see which stock funds are buying and selling. Many investors keep a close eye on Berkshire Hathaway's 13F filing since the conglomerate is run by none other than Warren Buffett, arguably the greatest investor ever. Buffett and Berkshire's holdings not only offer a glimpse into what companies they like, but also how some of the greatest investing minds are thinking. In Berkshire's latest 13F, Buffett made a tumultuous warning to Wall Street about the stock market. It couldn't be any clearer. Forget about the broader market. There's no shortage of investors who think that the market is overvalued. After all, we've been in 2+ year bull market, and the broader benchmark of the S&P 500 has logged back-to-back annual returns of more than 20%. Buffett appears to be one of these investors. In 2024, Buffett and Berkshire's hoarded cash and had over $320 billion of cash and short-term treasury bills at the end of the third quarter. Berkshire also sold more stocks than it bought in 2024, including big chunks of its largest positions like Apple and Bank of America. If you're an investor who studies Buffett and Berkshire, you know they have a knack for weathering recessions and severe market downturns. Some attribute this great timing to why Berkshire stock has crushed the stock market for decades. In Berkshire's recent 13F, the Oracle of Omaha made a tumultuous warning to Wall Street. Berkshire excited two exchange trade funds, ETFs, that track the broader market: the SPDR S&P 500 ETF, SPY, and the Vanguard S&P 500 ETF, VOO. Now, when someone sells a stock, it doesn't necessarily mean that the company is in a bad place. Perhaps the insider needed the cash to make a large purchase. However, in this scenario, we know Berkshire doesn't need the cash given its massive stockpile. It couldn't be any more clear that Buffett and the team at Berkshire think the marketplace is overvalued. Berkshire purchased both of these ETFs, and at the end of 2019, and for the very first time, it changed either position in over 5 years. This isn't too surprising, given that several indicators have suggested that the market is either overvalued or the economy could soon tip into a recession. A few examples include the inverted yield curve and the Shiller CAPE ratio, which compares the price of the S&P to its 10-year average inflation-adjusted earnings to smooth out irregularities. As you can see below, the CAPE ratio trades above its 5-year average and near highs seen right before the market sold off intensely in 2022. Is this time different, or does Buffett know best? It's rare to see the cause of a recession or a market meltdown repeat itself. That doesn't mean there won't be similarities, but they're often dressed differently and hard to detect before they happen. History can offer clues that help investors prepare for the future, but history doesn't usually repeat itself exactly. The market is in a very different place today than ever before. Congress flooded the economy with cash following the onset of the pandemic in 2020. A handful of companies currently consume about a third of the S&P and technology has integrated itself in our daily lives like never before. That said, Buffett and Berkshire have been navigating the market since the 1960s, so they have seen plenty of different cycles. While conditions are different, they could be masking similar issues that have led a market to a downturn. I would heed Buffett's warning and avoid entering new positions if they trade at expensive valuations. You don't necessarily need to sell or change your entire portfolio if you have a long-term investing horizon, but you should prepare for some volatility, perhaps a correction, even if short-lived. Should you invest $1,000 in the S&P right now? Before you buy shares in the S&P index, consider this. The Motley Fool Stock Advisor analyst team just identified what they believe are the best 10 stocks for investors right now, and the S&P index wasn't one of them. The 10 stocks that made the cut could produce monster returns in the next coming years. Consider when Netflix made it on the list in December 17th of 2004. If you had invested $1,000 at that time based on our recommendation, you would have had $552,526. Now, it's worth noting that the stock advisor's total average return is 942%, a market-crushing outperformance compared to the 178% for the S&P 500. Don't miss out on our latest top 10 tips list available when you join the stock advisor. So shout out to everybody who's still listening, and you kind of see what they're basically saying here. So Warren Buffett is not really buying any stocks right now. In fact, he's sitting on a ton of cash, and as we saw in the article, he's been sitting on a lot of cash, $300+ billion, almost approaching, I believe, $400 billion. I believe it was. Let's actually just confirm here. Yeah, $320 billion. So I'm a little bit short on that, but $320 billion of cash. And those short-term treasury bills, which for, by the way, people who don't know, it's just, you get a little APR on those treasury bills. I think 4%, 5%, depending on how long you have them in there. But even though it's still a lot of money, but the point is APY 5%, but he's sitting on this cash and he didn't purchase yet. They're saying, could that mean that there's going to be a crash soon? It could absolutely happen, And if there is a crash, right? Let's just put things into consideration. Things over the next 5 to 10 years after the crash allow you to multiply your income by it could be 30x. So it would be the first maybe $100 trillion hedge fund in the future. I mean, that could potentially happen. Berkshire Hathaway, who really knows? In the future, if that really does happen, imagine you buy $320 billion worth of stock at the bottom and then kind of wait for it to climb all the way up 10 years later. That would be a legendary move. But essentially, we like to learn and take advice from the greats. Warren Buffett is a great, and he's just sitting on cash right now. If you're invested already, kind of like me, I mean, there's nothing we could do other than wait for the upturn. Motley Fool kind of admits that this kind of position right now could be just, a short-term correction, which is quite interesting. So we'll take a look at that into the future and definitely evaluate. All right. So thanks for watching. I'll talk to you soon.